When the prospect of the trade war with China was first raised by then-candidate Trump, the prevailing wisdom suggested China would bear the brunt. Heavily reliant on American consumers and facing economic uncertainties, China seemed vulnerable, while the strong U.S. dollar was expected to cushion America from significant price hikes. However, the reality that has unfolded tells a different story. The U.S. dollar has weakened, and the American economy now appears to be on less stable footing. Moreover, China has demonstrated a surprising degree of resilience and leverage in this ongoing trade dispute, exceeding initial expert predictions. To understand the current dynamics, let's quickly recap the series of tariffs the Trump administration has imposed on Chinese goods since taking office. The timeline of these escalating measures can indeed be complex. Even before this administration, the average U.S. tariff on Chinese imports stood at roughly 20%, largely due to earlier tariffs targeting specific sectors like steel and strategically important items such as solar panels. This was significantly higher than the average U.S. tariff of about 3% on imports from the rest of the world. In a marked escalation, the Trump administration initiated an unprecedented tit-for-tat trade war with Beijing. This intensified on February 1st with a blanket tariff on all Chinese imports, Daijia on existing duties. China swiftly retaliated just 3 days later, imposing a 15% tariff on U.S. coal and liquefied natural gas, along with a 10% tariff on crude oil, agricultural machinery, and larger vehicles. The tariff volleys continued throughout March and April. On March 3rd, the U.S. added another 10%, prompting further Chinese tariffs on select U.S. agricultural exports. A more substantial increase came on April 2nd, with the U.S. slapping a 34% tariff on all Chinese imports. Beijing responded in kind just 2 days later with a symmetrical percent tariff. The rhetoric and the stakes continued to rise. By April 7th, the U.S. threatened an additional 50% tariff, and China preemptively matched this threat on April 9th, pushing its flat tariff rate on U.S. imports to a staggering 84%. The escalation culminated on April 10th when the U.S. raised its flat tariff on all Chinese imports to 145%. The following day, April 11th, China countered by raising its tariffs to 25%, effectively bringing bilateral trade between the world's two largest economies to a standstill. Initially, the Trump administration conveyed strong confidence in its strategy. Earlier this week, Trump asserted that the ball is in China's court, stating that China needed a deal with the U.S. more than the U.S. needed one with them. Echoing this sentiment, Treasury Secretary Scott Bessent told CNBC that China was in a weaker negotiating position, suggesting the U.S. had less to lose due to the significant trade imbalance favoring China in terms of export volume to the U.S. The underlying argument was that China's businesses relied more heavily on access to the vast American market. There was indeed some validity to this argument, and many economists initially anticipated that a trade war would inflict greater economic damage on China than on the United States. For instance, the Peterson Institute for International Economics estimated last year that a flat 60% tariff imposed by both nations would shrink China's GDP by a substantial $770 billion, while the U.S. GDP would contract by a comparatively smaller $327 billion. However, the actual trajectory of the trade war has deviated significantly from these initial projections. In a notable shift, the Trump administration has backtracked on several tariffs, including major exemptions for cell phones, computer equipment, and numerous electronic components, representing nearly a quarter of all Chinese imports. The U.S. is now also seeking renewed negotiations. Adding another layer, Treasury Secretary Bessent recently penned an opinion piece urging America's allies to join in economically isolating China, a plea that has garnered limited support given the current geopolitical landscape. In contrast, China is projecting increasing confidence. Bloomberg reported on Wednesday that Beijing is now demanding greater consistency and respect from the Trump administration before any talks can proceed. Furthermore, reports suggest that President Xi Jinping himself is unwilling to engage in preliminary discussions unless a viable deal appears genuinely attainable. Beijing has also reportedly called on Trump to exert control over members of his cabinet, a thinly veiled reference to controversial remarks made by J.D. Vance regarding Chinese citizens earlier this month. Adding to the assertive tone, China Daily, a state-run English-language newspaper, published an editorial this week telling the U.S. to stop whining. So why has the Trump administration's strategy not unfolded as planned? Several key factors appear to be at play. Firstly, China's reliance on the U.S. market has diminished significantly. In 2018, at the outset of the initial trade tensions, the U.S. accounted for 20% of China's total exports. This figure has since decreased to approximately 13%. Secondly, while American exporters might not face overwhelming losses, American consumers maintain a strong demand for Chinese goods. This, coupled with a weakening dollar, means the trade war could drive inflation to levels that are politically unacceptable within the U.S. This underscores the somewhat narrow view of trade deficits held by the Trump administration. While it is true that Chinese businesses sell a large volume of goods to America, this is largely driven by American consumer preference. In this respect, both economies exhibit a degree of interdependence, as evidenced by the recent U.S. tariff exemptions for smartphones. Of course, China's retaliatory tariffs will also contribute to inflation within China. However, it's important to note that inflation is currently lower in China than in the U.S. Moreover, the political implications differ significantly, as the Chinese leadership does not face the same electoral pressures as their American counterparts. This leads to the third crucial factor. The political dynamics of a trade war are more favorable for the CCP. President Xi Jinping does not have to contend with re-election concerns. Furthermore, America's aggressive stance allows the CCP to readily attribute any economic difficulties to external pressures from the U.S. Conversely, many Americans are likely questioning the economic pain inflicted upon them by tariffs, particularly given President Trump's initial promises to lower the cost of living. Fourthly, while China might face challenges in a purely tariff-based tit-for-tat trade war, it possesses other significant economic levers. Just this week, for instance, China reportedly canceled all Boeing orders, placing further strain on the American aerospace giant. China has also reportedly suspended the export of certain critical materials and magnets to the U.S. These materials are essential for a wide range of advanced manufacturing sectors, highlighting another asymmetry in the U.S.-China trade relationship. While the U.S. primarily imports agricultural products from China, which can often be sourced from alternative suppliers like Brazil, the U.S. relies on China for a variety of crucial manufacturing components and commodities that are not easily obtainable elsewhere. In a more extreme scenario, China could also choose to offload its substantial holdings of U.S. debt, including treasury bonds, potentially triggering a significant debt crisis. In conclusion, it is becoming increasingly clear that the Trump administration's trade war with China is not proceeding according to the initial plan. This development is not only problematic for the administration itself, it also sends a significant signal to America's other trading partners, suggesting that A, it is possible to win a trade war against the United States, and B, even the Trump administration may ultimately yield to domestic political and economic pressures.